Hello and welcome back to another episode of Financial News and Your Money. My name is Paul Munical. I am a financial advisor at Ameriprise Financial, and today's recording is being done on March 13th. A lot's been going on recently in the markets, so I want to dive right into the information I have for today. We're going to start out by talking about inflation with the narrow channel of weaker prices and how that adds risk to near-term inflation expectations. Now, the Consumer Price Index, otherwise known as the CPI, it reached a multi-decade high last June with a 9% year-over-year gain. Through January, headline CPI has moderated to a year-over-year rate of positive 6.4%. Through a material improvement, the gains have come more slowly than hoped, and recent data has many fearing that the pace of improvement could be stalling. Now, all of the improvement in the CPI rate thus far has come from falling goods prices. Service-related costs, which make up about 58% of the index, they've continued to increase on a year-over-year basis, although month-over-month rates have stabilized and are marginally off their highs. Likewise, shelter costs, which carry a very heavy weighting within the index, have also shown signs of stabilizing, but at high month-over-month rates, and they are still moving higher on a year-over-year basis. Now, the big news has been the Silicon Valley Bank, SVB. The situation may have taken a 50 basis point move off the table for the Fed's policy meeting next week. But tomorrow's CPI report remains very important to near-term investor sentiment in our view. Now, the Bloomberg consensus estimates currently look for tomorrow's CPI report to show a 0.4% month-over-month gains at both the headline and core levels. That would match our forecast rates. Now, should rates come in quote-unquote hotter than expected, the Fed could be perceived as being in a quandary as to how it can further ease inflation pressures without added pressure on bank asset liability matching. So there is some exciting news to watch in that front this week and see how we react in that scenario. Now, some of the few headlines. This is Ron Jankowski. He's off today. This is the part of the show he would normally give you some headlines in effect today before the market opening today, again Monday, March 13th. What we've got today is U.S. stock index futures are lower this morning as the banking industry remains the key focus for bond and equity investors. Also, we have markets in Asia closed mixed, with Japan down 1% and Hong Kong up 2%. Europe is trading down by 2%. Looking at the bond market, we have Treasury yields continuing to drop precipitously in the flight to safety, with the 2-year back to 4.05% and the 10-year at 3.45%. And looking at some safe havens, gold is up 1.4%. For Bitcoin investors, it's up 4%. And looking at WTI crude, it's down about 2%. Finally, we're going to look at the year-to-date index returns for some of the main indexes. The S&P 500 holding on to a positive return, but it is 0.9% positive. The Dow Jones has turned negative. It's down 3.2%. NASDAQ remaining the best of the three, being a positive 6.6%. So that's going to conclude the first half of today's show. If you have time, stay with us. and we are going to talk about ways to view your investments in 2023. Okay, thanks for sticking with us, and we are back with the Your Money portion of our show. And as I mentioned previously, we're going to talk about ways to view your investments in 2023. And I've got a few questions that I often get that I'm going to ask myself and answer them myself. Hopefully they will help you at home with similar type questions. We do know, of course, that as investors, we came off a really difficult year in 2022. Stocks fell into a bear market, officially defined as a decline of 20% or more from the peak highs. And unfortunately, the bond market lost significant ground as well. Now, the stunning jump in inflation after years of very low interest rates made matters even worse. So I know watching your investments and the value of the dollar depreciate simultaneously, it wasn't easy. And the prospect of more volatility ahead has many investors very nervous. As a financial advisor, I've fielded many questions from investors over the years and from my clients, and maybe some of these questions are something you may be contemplating as well. Now, keep in mind that while there's no single solution that applies to all investors, there are some general guidelines based on where the markets stand today and the historical record that may be helpful. So again, can't stress it enough, these are not specifics to you at home, but again, just a general guideline, things to consider with your own investments. So, some of the main questions I get, one of them is, how should I cope with market fluctuations that are affecting my retirement savings? And a general answer to that is, if you're within 5 years of your retirement date or already retired, be aware that you have less time to make up for losses in your portfolio. So you may want to reevaluate your risk tolerance, projected income needs, and investment strategies. It may make sense to pursue multiple strategies, seeking to grow a portion of your nest egg while protecting dollars you will need to tap more immediately, like in the next 3 to 5 years. If you are more than 5 years from retirement, focus on potentially mitigating risk in your portfolio with high quality investments and income producing securities. And if you have available cash to invest, think about doing so systematically, investing a portion monthly, maybe over the next 6 to 12 months. By dollar cost averaging in this way, you may be more able to offset some of the market's inherent unpredictability. Finally, if retirement is 10 or more years away, work on growing your nest egg. Time's still on your side. View the market's recent downturn as an opportunity to position your money in quality assets that are available at more attractive prices. Although markets will experience downturns from time to time, keep in mind that over a rolling 10-year periods, the broad stock market, we measure that by the S&P 500 unmanaged index of stocks, has moved higher. So keep that in mind. This next question I often get is, what should I do if I have not yet invested or I'm fairly new to it? So again, general answer to that question is, if you're new to investing, chances are you have a long time horizon before retirement and can potentially ride out the shorter term bumps in the stock market before you'll need to start withdrawing assets. Start by finding ways to save even small sums on a regular basis. This includes contributing to your workplace retirement plans, such as your 401k or 403b accounts, and putting money to work monthly in a traditional or Roth IRA. The sooner you start investing, the better your opportunities to accumulate wealth. And another question I frequently get is, if I'm very comfortable with the markets and volatility these days, how, if I'm very uncomfortable, I knew that was wrong, I'm very uncomfortable with the markets and volatility these days, how can I overcome that? And I tell people, while you may wonder whether you should invest in or continue to ride out the challenging market, it's important to stay invested if you can. You'll want to be positioned for a recovery which typically occurs without warning. Keep in mind that in the first year after the low point of the last 9 bear markets, the S&P 500 returned an average of nearly 50% from that low. Now, a good place to start is to speak with a financial advisor who may be able to help you steady the boat. Your advisor can help make sure that your portfolio is positioned to meet your key financial goals and is consistent with your risk tolerance level. You know, as there's no past performance is never a guarantee of future results, so you always got to take that into effect when talking about recoveries. There's no guarantee when and how and at what rate things will recover. But again, talking with your advisor on your specific situation is the best advice I can give. And if you're working with an advisor, of course, I recommend you speak with him or her directly. If you are not working with someone directly, feel free to give me a call directly. My phone number is 708-226-3412, and I'm happy to help. That's going to conclude today's show. My name is Paul Munichel. Again, I'm a financial advisor with Ameriprise Financial. I thank you for watching, and we'll be back next week with a couple of new topics. Have a great day.